Welcome back. Before the break, we were looking at Pakistan's return to global markets and the renewed flow of external financing from both investors and partner countries. From a $500 million Eurobond to billions in bilateral support and now discussions around expanding IMF exposure. Pakistan's external financing story is clearly evolving, but the key question is whether this signals real financial confidence returning or whether the economy is becoming more dependent on repeated external support to stay stable. Let's break it down. Mr. Rana, we were addressing a question right before the break. Pakistan stepped in as a mediator. Does that make lenders like Saudi Arabia more willing to extend support and on better terms? And what essentially is the situation with UAE right now?
Absolutely. Had there been no war between Israel and Iran and the United States of America, I think the Kingdom of Saudi Arabia would not have given the additional loan because there would not have been any need to get those loans. The situation turned for Pakistan on many counts. Everything was going well as far as the commitments by three major bilateral lenders of Pakistan was concerned. Like there was a placement of $3.5 billion by the United Arab Emirates in the State Bank of Pakistan, and the UAE had committed to the IMF that this loan would stay with Pakistan until September 2027. And that is the end date of the current IMF program. But because of certain developments, the UAE asked for its money and Pakistan gracefully returned the loan, and that created a hole of $3.5 billion. In this week, and we are giving this story, this news to our audience, that Pakistan first paid $450 million debt of the UAE at the start of the week, and today Pakistan returned another $2 billion to the UAE. So far Pakistan has paid back $2.5 billion to the United Arab Emirates, and despite that, there is no hole because we have additional commitments. And your question is and this is the right question to ask, whether if there were no war, what would be the situation? The situation might not have been the same, because it was the policy of the Gulf countries that they would not lend Pakistan money anymore, and the government of Pakistan should look for the investment opportunities. So war, sometimes it benefits, and Pakistan has benefited from it.
Right. So alongside that, Pakistan's Eurobond was oversubscribed despite a B rating. Is the market pricing again Pakistan's stability differently because of its new geopolitical relevance?
Well, again, Pakistan cashed the opportunity that was available to it. Pakistan's credit rating is B negative, which is highly speculative rating, and that means there are risks to the loans that any investor, individual or institution lends to Pakistan. In this case, Pakistan has B negative credit rating, and the Ministry of Finance assessment was that until there is further improvement in the rating, it may not be in a position to go to the international capital markets. But yesterday we had a news that Pakistan borrowed $500 million at an interest rate of 7%. But there is a little difference between this transaction and a normal capital market transaction. In fact, a private commercial bank, foreign commercial bank, gave this loan to Pakistan, and this loan was this time the euro bonds were not offered to the general public, which is the case. Like the money, the instruments, the debt instruments, these were kept limited to the institutional investors, and a foreign commercial bank bought those bonds in return of equal to $500 million at an interest rate of 7%. So on the one hand, Pakistan is able to take benefit of its new position, but at the same time, it does not mean that Pakistan's economy is in a position where it can raise debt comfortably from the international capital markets. And it is not just this case. Pakistan has been trying to raise debt from the Chinese capital markets through panda bonds, which is again a debt instrument, and this will be for the first time when Pakistan will be raising debt from the Chinese capital market. But that transaction has not been happening for long, and again this month, Finance Minister of Pakistan twice requested the governor of the Bank of China, which is the central bank of China, to extend the date for a submission of the application to raise the debt. Pakistan has been trying to raise at least $250 million. Now the government of Pakistan expects that this transaction might be possible next month in May, subject to the completion of many regulatory approvals that has to be done before Pakistan enters the Chinese capital markets. So in nutshell, our economy is the way it is, but because of our new geostrategic position and geopolitical position, Pakistan is benefiting from these transactions.
Right, that makes sense. But while we're on the topic, I would like to dig a little deeper about how meaningful a single Eurobond issuance is in terms of rebuilding sustained market access.
Well, that could be a good first step. And for the sustainability of entering in these markets, Pakistan needs to do a lot more. We are just talking about the Panda bond, and you know what is the issue with the Panda bond? Pakistan directly go to the Chinese capital markets to raise this debt. Instead, two multilateral banks, the Asian Development Bank and the Asian Infrastructure Investment Bank, they are giving guarantees to the Chinese investors that Pakistan would return this money to the investors. Pakistan would not default. So that means Pakistan's credit rating, which we are talking about, is still very low. So Pakistan is looking for the guarantees, and these institutions, two multilateral development institutions, have provided those guarantees, of course, in return of fee. So Pakistan can do these capital market transactions without the support of these international development banks only if its foreign exchange reserves are at a comfortable position, which are still in a better shape, but we need to improve more. Its credit rating is around B, not B negative. It should be higher than this, at least 2 notches. There is a stability in the economy. Pakistan's fiscal deficit is under control. Pakistan's external account is under control. So there are indications, there are indicators that Pakistan need to improve. Only then we can say that Pakistan can comfortably enter in the international capital markets.
So, Mr. Rana, as we know, Pakistan is asking for $2 to $2.5 billion more from the IMF. Does a war-related justification strengthen its case or highlight chronic external dependence on the IMF and others?
Well, at the beginning of the war, when the IMF mission was in Pakistan, Pakistan's position was that its economy is not impacted by the war, and this is the reason Pakistan didn't go for any relaxation against the fiscal targets and the external account targets. But as the time passes, now the government of Pakistan has changed its position, and it is looking for additional IMF loan. There are two possibilities. One is that Pakistan can get a new financing line from the IMF. The chances are very, very low. Because that is more time consuming exercise. At the same time, the managing director of the IMF, it has given us, she has meant that she is expecting, at least her institution is expecting $50 billion additional demands from the regional countries because of to offset the impacts of the war. Given the statement of the managing director of the IMF, now Pakistan has decided to request the IMF to give additional loan. The possibility is that the existing $7 billion extended fund facility, which is ending in September next year, Pakistan may request the IMF to increase the size of this loan. Every member country of the IMF has a right to take loan from the IMF for the balance of payment support. But there are quotas. In case of Pakistan, Pakistan's quota is 600%, which means Pakistan can borrow a total $16 billion from the IMF. But 600% does not mean that Pakistan can exhaust the entire quota. Right now, Pakistan has already exhausted about 350% of its quota, which means around Pakistan has borrowed or the loans are approved already, principally approved, equal to $9.5 billion. So Pakistan expects that it can still comfortably avail another $2.5 billion from the IMF, but there will be conditionalities for that. There will be higher interest. So there are so many things that Pakistan needs to address before looking for this loan.
So would you say that Pakistan, having used most of its quota while still having some room left, is acting like a real buffer, or is Pakistan just using that like a last resort?
It is not the last resort. If the IMF does not give the additional money, there will not be any problem for Pakistan. Saudi Arabia has this week given $3 billion. $2 billion has already been $2 billion have already been transferred to the State Bank. Our foreign exchange reserves are around $15 billion. But if the money comes, this time the cost will be high. because the more you borrow, the higher are the interest rates and higher are the surcharges. During his visit to Washington to attend the IMF and World Bank spring meetings, Finance Minister of Pakistan Aurangzeb has raised this issue of higher surcharges and its implications for the developing countries, and that means that the IMF should reduce the surcharges to make it convenient and affordable for these developing countries to take the additional loans. Right now, Pakistan is paying about 5% interest rate on the IMF debt, which is high given the fact that the lending by these multilateral institutions like the World Bank, ADB, and the IMF is considered relatively cheaper. We have just borrowed $500 million, 7% interest rate, which is in the case of a commercial bank. But if the interest rate of a commercial bank and the IMF is almost closer, then it is considered as quite high rate.
And would you say that these surcharges really bite at this stage, or do they get lost in overall financing?
No, definitely it bites, because the amount is and the percentage is quite high, and this is in dollar terms. This is not in rupee terms. 7% on $500 million means Pakistan would be annually paying about $35 to $37 million per annum over a period of 3 years, because we have borrowed this debt for a period of 3 years. Yes, situation is tight. Pakistan needs to improve its exports, which are not growing. Our exports are down by 8%. The remittances is the only non-debt creating inflow for Pakistan, which is coming without any cost, and the government of Pakistan is trying to maintain and retain the flow of these remittances. Again, according to the IMF report, according to the ADB report, there are few risks to the remittances because of the Middle East war, but hopefully the way the things are moving, and if the plans are executed and there is peace, there is soon peace in the region, hopefully our remittances would not be impacted. Rather, there will be opportunity to earn more remittances, because the kind of destruction that has taken place because of the war, these Gulf countries, they will have to go for a reconstruction phase, and Pakistan's labor is relatively cheaper compared to the other countries. So there is opportunity. Pakistan can earn more remittances. So hopefully Pakistan's position will be better, but still it will take longer time to reach to a point where it does not need a new loan to return an old loan, where the interest rates are low, where it can float the bonds in the global markets without securing the guarantees from the multilateral development institutions.
Thank you, Mr. Rana. That's all we have time for today. Again, a big thank you to Mr. Rana for joining us. Thank you for watching. Don't miss our next update next week, same place, same time.